Hello and welcome to Trading the Trend. The question we ask ourselves each week is, what trends are we riding? And actually, the question we should also ask ourselves is, are we maybe protecting ourselves in some of these trends? Not a bad question to ask on some symbols. JP actually says something I think is worthwhile saying. Josh Pink, that is. Josh Pink says, feels like there's a giant sale sign over most equities. We'll talk about that. And we got with us Connie Hill in the chat. We welcome her and we welcome all of you here today as we talk about 5 keys here today with really the process of really trend trading. Now, we'll go over those 5 keys. What are some things that I wish I would have known when I was first getting started, even intermediate, even now? Just real quick as we get going, want to give us a quick reminder that with what we discuss, we'll talk about stocks. We will also talk about options. Sometimes you'll look at options maybe to do a directional trade. Sometimes the investor might consider options as a way to protect capital and or the portfolio. That's the goal. So also, and we'll show an example or two of that. Sometimes options might be used, let's say, to do a bearish trade, okay? All the above. Now, also remember that the information here is provided for general informational purposes only. When we talk about examples, we will do those in the Paper Money software application. Also, as we talk about investing, understand that investing involves risk. Without risk, there is no potential reward, okay? So there's risk here, including loss of principal. And also remember when we talk about short options, maybe selling calls or selling puts, we're talking about American-style options where those can be assigned, okay, the call or the put prior to expiration, regardless of the in-the-money amount. And also when we talk about futures, we're going to talk about futures prices like crude oil or gold, etc. We're talking about that. We're not trading those, but we're looking to see how those prices are impacting indexes, equity indexes, sectors, industry groups, and so on, and even stocks. So also when we talk about that, we'll bring that up. Now, let's kind of hop right in and kind of just talk about some of the main trends that we're really seeing. So first off, when we talk about some of the 5 keys, we got to know the trend types, okay? And so when we talk about know the trend types, we're really talking about trend 1 through 5. Now, if we know what the trend types are, we kind of know what to expect. Let me show what I mean by this. So if I told you today that we had VIX up, we had crude oil up. What's the symbol for crude oil? CL. We could just use that example given. CL is up to almost 80. We also see, for example, the rates, okay, have actually been going up quite a bit in the last little bit here. What, 20 basis points, 30 basis? No. Just a sec. I'll make sure my math's right. Got 50. No. You got, so it went from 3.95% to 4.1-ish%. So a pretty decent push there on the interest rate. So you got VIX up, you got oil up, you got rates actually pushing up. Now it's not just that. We got the US dollar going up as well. I mean, if we said those 4 symbols are all going up, what do you think the equity market would be doing? And I don't think you'd be hard-pressed to actually say, I bet it's going down, okay? Now, let's look at the first chart just real quick when we talk about trends. So when you look at this chart being the Dow Jones itself, now remember, first thing we want to know is what type of trends we have. What are we going to expect? If we kind of know what the trends are, the different types of trends, we know what to expect. It doesn't completely take us off guard. If the price is below both moving averages, but especially the 10-period moving average, which is the blue line, it's not really shocking to see selling pressure. If you do get up days, you tend to get up days less than 3, represented by green candles, and then that 10-period moving average might act like a ceiling or resistance. Now, I'm going to show you something. I don't normally bring this up, but when the markets fall down below the red 30-period moving average line, you might look at, let's say, moving averages that are longer. I don't always have this here because it's not always applicable on a daily basis. I'm going to actually put the 100 period moving average on, which is going to be shown in a white color. The Dow, if you take a look at this, the last times we've been down in this area, which is not very frequent, thank heavens. Hate the 100 period moving average, especially if you're talking about you're in the trends already. Now, if you're looking to buy something, you might say that's a different conversation. The last time we were down here, you got the May. You also got a little touch here down, let's say in November. And here we are right here, okay? Now, I'm going to tell you, when you look at some things, yes, there's some things going down, no doubt. But I think when we really talk about some of the trends, there are some interesting canary in the coal mines that are happening right now, and we'll get to that. Let me show you what these look like. So first off, when you look at the SPX, where are we at on the 100 period moving average there? The answer, let me widen that out so we can fully see it. It's going to be, we're slightly below it. 68.20 is where that's at. If you said, could you put on that 200 period moving average, I don't like to even put that on because that's way far down there. But if you said, pretty please, I'll put it on there for you. And if we put that on there and just said, just show me where that's at so I can identify the 200 period moving average, which we have not touched since last May, is sitting right at 65.78. Not that far away, okay? So the white line is the 100. The 200 is the yellow. Now, when we talk about these trend types, right? If we go to this chart, the chart that I think is really helpful is really getting into these different types of trends. And let me bring that up, and it might not, let me actually grab that chart. It might not be loading the way I want it to. Yeah, I'll pull it up on a different chart. So the reason why I want to pull up this chart, because I think when we drop down, right, there's going to be questions as far as where those moving averages are. Fair. That's why I showed that. Now, what about the NASDAQ? NASDAQ is it's been below the 100 period moving average for a while. It's 130 or above us with a 200 period moving average on 24,177. So when you take a really look at the NASDAQ, we'd have to say the NASDAQ, at least in the last week or two, has gone down the lesser amount. And the Russell is kind of sitting right on it right now. Now, the question was asked the other day, such as, how do we kind of know we're getting to that crescendo moment? Look, when you get to the point where there's nowhere to hide, gold is down, silver is down, staples are down, utilities are down, real estate is down, healthcare down, okay? All those areas you would think about hiding, they're even down too. And that's kind of what we're seeing right now. Now, you might say, well, is that bad? Well, remember, if the market really sells off aggressively, that is not really unusual, okay? Now, I'm talking about these areas that people tend to hide. So when we talk about, let's say, gold is even starting to show signs of cracking a little bit. Silver is actually showing some signs of cracking a little bit. Looking up at that red 30 period moving average, when you look at, let's say, utilities, they might even look a little top heavy, a little bearish engulfing to the downside. Staples actually has been pushed down. And the one that's hurt some feelings here today is really been on healthcare, down 2.62%. Pretty good push down on healthcare. So seeing these areas that tend to be more income and value, that's kind of more of a sign that it's not just selling in the tech and discretionaries and the communications, but they're even selling the stuff that might not make a whole lot of sense in terms of it doesn't tend to be as volatile. The businesses tend to be more resilient. The businesses actually pay dividends, etc. And even these areas are being hammered. Okay, fair? Now, let me kind of show you something what I mean by the canary in the coal mine. Okay? So when I say canary in the coal mine, if I look at, let's say, technology, in the last 5 days, we've kind of been more flat, IXT. If we looked at, let's say, discretionaries, they've also been a little bit more flat, okay? The one that's been a little bit interesting is if you look at $ IXC, the communications services, they're not even down. Now, if you said if there was going to be any sectors that were going to be down in volatility, you'd probably say technology, discretionaries, and really communication. And really, these are starting to show some resiliency. Now, the other thing I want to kind of point out here is if I looked at a couple Dow stocks, okay, and if I pulled up some of these Dow stocks, and let me just kind of turn those moving averages off, okay? Now, let me show you a couple Dow stocks. Let me show you what I mean by canary in the coal mine. Why is Salesforce going up? Why is IBM going up? Okay. Why is Microsoft starting to show signs of reversal? Why are we starting to, for example, see stocks, example given like Zscaler, starting to show signs of bottom, getting above the 10-period moving average? Why are stocks like PanW going up when the market's going down? Why is a stock like PayPal, okay? Why has it been going up and the market's been going down? So this is kind of the other point I really want to bring up, which I mentioned is these are kind of interesting when you see stocks that were down, those stocks that have lower correlation to the market, they actually start sometimes going up. Now, we're going to come back to this area, but let's just kind of finish this main point, okay? So when we talk about different trend types, I want to see if I can't bring it up on this chart, right? Yep, this is the one I'm looking for. There it is. So first thing, let me share this specific chart with you, okay? This is the one we're looking for. So one of the hardest things about the market, I think, is let's say we were looking at a stock. I'll just go back to the Dow because we were talking about that. But if we see, let's say, example given that we have red color candles on the chart, the hardest thing to actually do is sometimes let the market drop. We're impatient. I know I don't have any patience, but I have a reason. I have 4 kids and a dog, okay? And those kids, they've just taken all the patience out of me, okay? The wrinkles underneath my eyes, it's totally on them, okay? Now, here's the deal. So when we see the different types of trends, if you say, I don't know what these color candles really represent, with what I shared to you, if you said, I actually don't know these types of trends, go to the test tube right there, test tube, and you're going to see that if we go right to the very tippy top, I'm going to go to, let's go to this. What I want to do is click on, let me just double check. Yep, there it is. Yep. So this will actually show us what do we mean by trend types. I'll give you the quick cliff notes. So different types of trends, 1 through 5, right? And when we read through this, it's going to really show us, if you read through that, it's going to show you what do we mean by different types of trends. 1, okay? What does that mean? It's talking about the price in relationship to the moving averages. Scroll down and read that. Very important. A little write-up in there. It's right there for you. Go get it, okay? So when we actually do that, how do we do that again? Click on that little test tube. Go down to actually where it has that little sheet of paper right there. Click. And now you're going to see that it gives a little write-up of what do we mean by these different types of trends. So the different types of trends is in relationship to where's the price in relationship to the moving averages. Now, I want to come to some examples and we'll talk more about that. The second thing that I think we need to actually make mention of is trading, investing is the opposite of emotion. Now, don't laugh at me when I tell you this, but when I first got started investing, if I would have done the opposite of what I did initially, probably would have been profitable. You ever feel like that? The opposite of what you feel, the opposite of what you think, okay? Now, maybe that was just for me. Now, the biggest actually thing is when we talk about this, I'm also going to bring up with this point correlation. Let's start here on these points. We're going to talk about these points 1, 2, 3 here, okay? Now, I want to go back to a stock example, and I want to look at, let's say, a stock like CRM. Now, with CRM, this will kind of give us a little bit more clarification on what do we mean by the trend type. Well, and this will be our first example. Now, if you take a look at the color of the candle, red color candles, that's actually telling us that we are in what we call trend number one. And we could see it. It's showing it down here, trend number one. On the right-hand side, you're going to see down here, 1, 2, 3, 4, 5. Trend one, just meaning the price is below both moving averages. Okay, not bad. Now, light green, price is above the blue line or the 10-period moving average, but not the 30-period moving average, which is in red. The green color actually right there, what we can actually see is that is actually where the stock is actually, that red line should be a 30-period moving average. We fixed that. And now what you're going to see is why did that color of the candle go green, dark green? Well, because the price is now above both moving averages. Now, the other point that I want to really bring up here is really diversifying strategy. Now, sometimes we've heard of a word, this term, I should say, diversify strategy. Okay? So sometimes people might say, well, I'm a stock investor only. So they just go long and they hope it goes up. Some people are like, nah, you know what? In different type of situations, I might want to maybe consider an option strategy. Something that actually has a different risk profile, okay? How much capital is involved, whether there's a maximum gain, a maximum loss, etc. Sometimes when volatility goes up, sometimes investors might want to use strategies like cash secured puts, short put verticals, and so on. Those have different defined max gains and max loss compared to stock positions. Now, in this first trade example, what we're going to try to do is a lot of times when the investor tries to get in, they're trying to really say, well, how much risk is there? Or how close are we to support? Well, now what you're going to notice is on this chart, there was a recent pullback area there, which was pretty much where that breakout area was, okay? Now, with the volatility in the market being higher, volatility on individual stocks, they're also probably higher. So if I go to the trade tab, let's go to the trade tab, we're going to consider doing an option trade on this. Now, when we talk about an option trade, we're going to go to not the March expiration. That has 15 days expiration. See the parentheses there. The April expiration has 43 days left. We're going to try to go a little bit farther out in time. Why? Well, because when you have more volatility, you're trying to get the volatility to die down some, okay? And if the volatility goes down, which is expressed in the annual percentage here, we're trying to have time work on our side and the volatility go down. Time going by, etc., can help this position. Now, what we're going to try to do in this case is, if we know there's more volatility in the market, does it make sense to go closer to the current stock price or sell a strike farther below? What's the answer to that question? Does it make more sense to say sell the 200, hope it stays above the 200, or sell the 195, or sell the 190? Now, we all know the answer. Well, I want more money. Well, yeah, but are you willing to take the risk? No, I don't want to answer that question. I just want more money. Well, remember, you lift up one side of the stick, it's moving the other side. Okay, reward and risk. So if the investor says, look, I think the market's more volatile, I'm going to pick strategies that have a defined risk, but I'm also going to pick a strike that is farther down, that also has a lower delta on it. Now, if I actually said, hey, sell the 190, that has a 31 delta. 31 delta meaning that the stock has a 31% chance to be below the 190 strike at expiration as of right now. We're going to right click on that 190, sell, and we're going to actually do, in this case, the strike right below us. Now, if I did the 190, 185, there's a max credit built in of $152 a contract. If that's the case, that means there's a max loss of 348. But the way you get to the max loss is it's below both strikes. The way you get to the max gain, the stock is above both strikes. The profit is less than the reward because it's a probability type trade. And the stock could even go down somewhat from 202 down to 188 to break even. So wait, stop for just a second. So when we talk about these 5 keys, we're really talking about knowing the trend types. Well, why are we doing a bullish trade on this? Because we got a little reversal going on. We actually were in trend 1, price below both moving averages. We actually were in trend 2, price above the 10, but not above the 30. We saw that today being trend 3. If you went back and looked at different types of trends, you probably would have wished you would have been in those trend 3s doing bullish positions, okay? Now, also the other thing is trading and investing is the opposite of motion. When you go back and look at a chart like this, the emotion is, well, it's been down. That's true. It has been down. But when does that change? If I were to show you this stock all the way up to 280, you would say back to me, geez, it would have been nice if we got in down here. You get my point? So the thing is, we had a first higher high, the first one. We've actually been in the process of really making a higher low. And actually, we today made another higher high. This is the second one. Now, when we talk about diversifying strategy, this is where the investor might say, in different market conditions, I might want to use different tools, strategies, because I want to try to use different things like time, max gain, max loss, probability, and so on. Now, what we're going to do in this trade example is we're going to come in, we're going to show this. Now, let's say we said, look, we cannot risk more than $500. Therefore, we cannot do more than one contract. Okay? Cannot do more than one contract. Would like to, but if we're following and saying, look, I can't take more than $500 worth of risk, that's what we could do. Now, in this trade, you're going to see that the commission is $1.30. Note that. Send the order. There it is. Yeah, that's a good way to say it, okay? Now, let me kind of bring something else up. Now, how many of you are stock investors, okay? How many of you are stock investors and say, you know, James, I'm really a stock investor. I like to buy when the market pulls back, but I'm just scared, okay? Now, I'm going to go back to something for just a moment. And what you're now going to notice is on this chart is we can see, and I'm going to circle some of these recent highs, okay? You got a high there. You got some highs here. Now notice where I'm circling the highs. The highs are the green colored candles. And there's some more green colored candles. And there's another green color candle. Now, what we can do now is just connect the dots to dot, okay? Why do we care? Well, because if we go from there to there to there to there, we get a resistance line. Now, some investors might say, look, I want to get in if we get above that line. Noted. But sometimes people like to get in close to support. Now, we're not saying this is our favorite strategy. Not saying that. But let's say the investor says, look, I like to buy shares of stock, but I'm a little concerned. I want to have a stock position, but I want to maybe kind of hedge my downside and still have some upside. But I want to know that if I was going to go maybe on a vacation for a week or two, it can only be so good to the upside. It can only be so bad to the downside. But I want to get exposure to that stock. Now, there's 2 tech stocks, lower price, that we're probably thinking, let's do these 2 examples on. So, and let's practice, okay? So one of the points we want to really bring up here is diversifying strategy. So this first example we did was a short put vertical. But wonder if you actually said, James, I want to do like a collar. Now, when we talk about this collar, we're talking about buy, right, protect. Now, when you say buy, what are you referencing? Buy the stock, write the call, and protect, meaning buy the put. What does that look like? How would someone do that and walk me through the numbers? Well, let's do step 1. If we want to do a trade, let's go to the trade tab. Click on the trade. Now, step number 1, we're going to go right to that margin account. How do we buy the shares? Well, go to the trade tab. We got the ticker there, and we got the stock information up top. Okay, not too bad. This is like a touch screen, okay? And if we go to touch screen and we click on the ask, if I click on the ask, it's going to come up with, in default, which you can change that if you want to, that we're buying 100 shares of stock. All right, that's not bad. Click on the ask, you get a buy order. We can change the number of shares, we can change the stock price, we can change the limit order, time, and also the timing force, day to GTC, whatever, okay? Right there. Now, what we want to do is we want to go to that where it says advanced order, single order. Now, we're going to do this in sequence. Number one is we want to buy those shares. Number two, we want to actually we want to sell a call and buy a put. Now, I'm just going to show you something, and this sometimes blows people's minds. But if we were to, let's say, diagram this stock position, it would just be a diagonal line. So if this stock example given is right here, okay, so this is where the stock price is. If this stock goes to the right or higher up in price, and on this y-axis is the profit and loss and expressed in dollars, yeah, of course, it's just plotting what the gain or loss would be. If the stock went to the left or down, it's going to show what the gain or loss would be unrealized. So nothing really new there, just diagramming that. Now, where this becomes a little bit more interesting as we come back to the trade tab and say, look, one of the advantages of having a higher volatility is when you have that high volatility, you could try to sell some calls or puts. Well, let's say the investor says, you know what, James, I want to maybe try to sell something like the $49 call, okay? Now let's think about this like a house. I buy the house for $45,000. I agree to sell it for $49,000. Not a trick, okay? Buy it 45, agree to sell it 49. You would probably not do that for free. You'd say, give me some money, honey, if you want me to agree for a certain period of time to sell it to anyone out there. So this premium right there is what that is for. From now to expiration, agree to sell it to anybody. We'll sell 100 shares at 49. We get up to 49, but we also, okay, get the 239. Now, if we did this and just said single order first triggers SEQ, you're now going to see that we're just going to click on the bid. If we want to sell the call, that actually is going to be it's going to bring up a sell order. How do you know it's a sell order? Because it's in red. How do we know it's a sell order? Because it says sell. How do you know it's a sell order? Because it says -1. This right here is called a covered call. Now, here's the deal. The covered call is a protection strategy. That's not really true, okay? It's an income strategy. The thing is, it caps the upside, but what you're now going to notice is if the stock actually goes down to the left, it's unrealized loss. It's actually, if I went all the way to zero on this chart, I slid it over, and the stock went to zero, there is a defined loss, but the stock would go to zero. That's not really a great outcome. I mean, I'm not sure if that's a selling point for many. Now, if I slid this back over, many investors would say, geez, is there any way to make it where the floor, if you will, is not zero? Well, yeah. The investor might say, I'm willing to take some of that or all of that, and I might come over here and buy the put. Now, if the investor said, look, I'm going to come and buy the put at 42. Now, remember, if you ask the people, why don't you buy puts? I don't do options. If they do options, why don't you buy puts? The number one answer you're going to get is, I didn't want to pay for them. That's what they're going to say. Okay? I've asked thousands of people that. The number one answer, I just didn't want to pay for it. The thing is, if the stock goes down in a way indirectly, you are paying for it. You get it? Let me repeat that. Go back. If the investor actually holds onto the stock and the stock goes down, they are kind of in a way indirectly paying for it, at least in terms of unrealized losses. Now, we're going to actually take that premium right there, 237. We're going to click on that 239. Now, if I tried to actually collect 237 and pay 237, this is what's called a zero cost collar. This is the third point, okay? In terms of riding trend, is this a bullish or a bearish trade? Not a trick question. This is a bullish trade. How do we know it's a bullish trade? Well, because these red lines right here, this is where the stock price is right here. If the stock goes from 45, 46, 47, 48, 49, we could actually make almost dang near $400. Now, if that stock went down, if we go from $45 to 44, 43, 42, how bad is it? Answer, it's about a potential loss of $300. Now, if we take a look at this, so if you looked at the numbers, $400 if it just goes to the upside and over 49, but if it closes below 42, max loss right around 300. Now, here's the deal. So it is a bullish trade, okay? Now, if we did this, what I'm going to do is going to come to this, and we're going to do, this is going to be one of them, but we're going to do one more. Because I think there's a lot of investors that say, James, I know in my mind, when the market goes down, that those are some of the opportunities, but I'm scared. Well, now at least the investor could get in and kind of know they're at least trying to get in some exposure here to some stocks they might want to try to get into. Now, notice how on the call and the put, notice how in that case, I chose the ones that had a delta of 30 to 40. Could we maybe go a little bit higher on the call side? We could, but we're right in that range of what we normally talk about anyway, okay? We're gonna go confirm and send that order. And notice the commission. Selling a call, 65 cents a contract. Buying the put, 65 cents a contract, okay? So now, the one other thing about the caller that I think is it's not really well understood. When someone does a caller position, the delta is not 100, okay? It's going to be, what you're going to notice is the shares, if we buy 100 shares of stock, 100 delta. Delta is explaining to you the rate of change in profit or loss. 100 shares, stock goes up $1, rate of change in profit, $100. Okay, 100 shares, stock goes down $1, rate of change in profit or loss, in this case would be a loss, down $100. But when you sell the call and you buy the put, what that's really doing is it's lowering the rate of change in the gain or loss. Oh, wait, why is that good? One simple answer, because you're trying to handle the volatility. That's why. So when someone comes in and they're just buying shares all over the place when the VIX is at 50, and they say back to you like, man, the market's super volatile, it probably tells you they're swinging with a big stick in terms of shares of stock, and they're probably not realizing there's other strategies to try to take a bullish position without swinging a big stick, which is capital intensive, and it's the highest up on the scale in terms of directional delta exposure. So what I'm telling someone is you might want to consider putting that big stick down and realizing there's other strategies where you might not have to swing as big as a stick as shares of stock and still getting bullish exposure while defining the risk. Now, if we look at this position, the delta is 27. Remember, big stick, 100 shares, 100 delta. Well, now that stick is shrunk down to 27. So the stock goes up $1, $27 unrealized profit. Stock goes down $1, unrealized loss 27. So now we can move around more, and it just doesn't matter as much. It's very important. Today's title might literally be called Consider Putting Down the Big Stick. Now, how did I know that? I started in markets before 2000. And trust me, in 2000, the markets went down quite a bit. I've seen markets like 07, 08, 09, right? And so sometimes just coming in with a big stick or big number of shares, high delta, could someone make a lot? They could. They could also lose a lot, okay? Now, what I want to do is also kind of make mention of, just kind of get to other questions. Now, yeah, the other one, it just hadn't filled yet, okay? So all of those filled. So let's go back and kind of take a look at which ones did we do. So we bought 100 shares of Intel, and we sold the call and bought the put. We saw that right on the monitor in the filled order section. Now, in the IRA account, if we went back to that just real quick, if we look at that and say any orders filled there, what order did we do? The example given that we talked about was CRM, okay? And that order is sitting right there. And that was a vertical. That was in April 17th, 190, 185, okay? Now, are there any other questions? Now, as I'm kind of typing this in, I want to kind of write down this next thing. So number 1, okay, 2, 3, 4, and 5. The other thing I think we kind of need to understand here is dollar cost average. Now, historically, when I got started with dollar cost average, now, when I first started investing, it was like $19.95 a trade. So if I bought 1 share of stock, $19.95. If I bought 50 shares of stock, $19.95. So dollar cost averaging back then, there was $14.95, there was $12.95, there was $9.95, $7.95, worked its way down over time, then to zero on U.S. listed equities. Dollar cost averaging usually had to have a big account. But with, buying U.S. listed equities, you could spread out those entries. Why don't people do that? Because they're not patient, okay? So the big thing about when you have different types of trends, like trend 1 in the market, it's okay to be patient and try to pick those spots. The thing is, dollar cost averaging also assumes that you're looking at similar stocks on a day-over-day basis. Now, I'm going to go to a stock just real quick like IBM. Now, on a stock like IBM, wonder if the investors said, you know what, James? Now, I'm just going to show a couple stocks just real quick. IBM looks very much like CRM, very similar. The point I really want you to understand with Salesforce, CRM, and IBM is understanding correlation. Things that had gone down first, they sometimes tend to bottom first and go back up. Things that, for example, that have been going up, that have lots of profits in them, some people actually might say, look, I want to profit take on some of these stocks that are going up. Why? Because there's some profits to take. I mean, you think about if you're a farmer, right? You have a farm, you raise corn, and you're going to go out and cut what? Dirt? No, you're going to go cut the field that actually has 6 feet of corn, okay? So when you see stocks that have been going up, investors could become, well, where they actually say, look, I want to trim some profits. I think these could start pulling back and try to get in some new positions that might be starting to go back up. Now, I don't have anything really to say on Amazon here today. That's been one that we've kind of been doing the exact same thing. We'll add CRM to that pile and IBM. Amazon, pretty good push here today. Did go up to about, what, 220, okay? Now, I want to find the next one. Now, if we take a look at, let's say, a stock like, I'm going to go back to a stock like PanW. Now, PanW, if you look at this, we might say comments like, well, yeah, we're at that 30-period moving average. It cannot go any higher. Well, so that was a comment that was actually brought up to me last night, okay? So when we talk about too high, we're talking about like the trend of Johnson & Johnson, where day over day over day over day, it was just going up higher and higher and higher. When we talk about that, right, if you get a stock, for example, like Johnson & Johnson, where that stock was just going up higher and higher, we're talking about the trend. That blue line right there, light blue, that's your 10-period moving average. That yellow line right there, that's the 3% line above the 10-period moving average. So when we talk about higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, we're just talking about the trends, okay? But if we're trying to literally pick an entry, we're asking ourselves, well, how high? We know they can keep going higher. If we're trying to get in, well, how high are we above that short-term moving average, namely the 10-period moving average? Now, remember, we said we graded that if someone was trying to buy the stock above the 10, but no more above the yellow line, some investors might call that an A grade. If someone said, hey, James, I'm going to get in between the red and the yellow, these moving averages, maybe that's a B. C would be between the red and the white line. And D is just saying, look, we're elevated. And now we're kind of, in the short term, we are still saying, yes, it could keep going up. But in the short term, what is the most likely thing going to happen? The most likely thing going to happen is it could probably pull back in the short term. In that pullback, could it try to make a higher low and go higher? Yes. But we're talking about we're talking about the entry, okay? Now, the example that I'm going to look at in this case is PAN-W, okay? On the stock PAN-W, pull this back up, we're going to kind of look and see, well, where are we? Well, if we kind of looked at PAN-W, you're going to see that we're right now at the red line. We would kind of grade this as B. Well, why didn't you get in this morning? Because my class wasn't this morning early. It was now. All the examples we do in class. Now, in this example, let's imagine the investor said, James, I want to try to get in thinking that that price might snap its way back up. And we've seen that before. You got a resistance at 1,767. You got a major resistance at 180 or so. Now, if the investor said, hey, I want to go back to that short put vertical, is it possible to maybe try to sell something thinking it might stay above a certain support level? Now, remember, the nice thing is with different strikes, we could try to pick a different probability. Now, if we take a look at this, what you're now going to notice is the 160, the 155, the 150. Now, what I'm going to show in this example, in a minute or less, we're going to sell something that even has a lower delta than 30. Well, you do that, you're going to get a lower reward, bigger risk, but a greater chance in being potentially right. If we sell the 150, and then say example given, buy the 140-ish to make it a $10 wide spread, well, that's going to give us a $1.86 credit. Now, who does that? People that want to have a greater chance of being right. However, if they are wrong and it does not work out, that defined risk is literally at 814. I want to bring that up because in the current market environment, the investor might say, look, I want to have greater odds of being right, number one, and second, how much money is it, okay? Many investors would say, I need at the minimum 20% ROR. 186, 814, what do we got? And the answer is 22%. You cannot go any low, well, you could, but in our example, we need that number percentage to be at 20% or higher to do the paper money example. Any lower than that 20%, you got to start to question, is it worth it? Okay. Now, I got to wrap it up here. The key points we want to really bring up here today is know the types of trends. That chart that I sent you, I think is very helpful in actually identifying and not second guessing yourself. Trading and investing is the opposite of emotions, okay? They could have a whole class just on that topic. If you would do the opposite of what you've done, would you have done better? What was the difference? It was the emotion. The longer I invest, the less I ask myself, how do I feel? It doesn't matter how I feel, okay? Are the trades aligned to the trend? Okay. Third, correlation, major. Seeing some canary in the coal mines right now. Some of these tech discretionary communication stocks getting a bump while those income names being pushed down. That is suspicious. Keep an eye on that. Diversifying strategy. It's okay to put down the big stick. Maybe consider different types of strategies where there's defined risk. And also understanding dollar cost averaging. Getting to know a couple names and trying to add to positions over time. Okay. Now, I'm out of my time here today. I want to thank you so much for attending today's session. And remember, if you have not subscribed to the Trader Talks channel, right on YouTube, it's free. Okay, all you got to do is just click subscribe. Now, also remember, you can follow Connie and myself on YouTube. Okay, excuse me, on YouTube here by joining the Trader Talks. But you could also find us on X. There's my handle there at the bottom, and here's Connie's. And we actually do post educational content there as well. So I also want to kind of say just real quick, stay tuned for our next webcast coming up next on short verticals. And also remember, with what we discussed, it was done for example, illustrative purposes only. And I'll be back on tomorrow talking about ETFs tomorrow with Kevin Horner at 9:30 a.m. Eastern. So that's thank you so much for your comments and your participation. Stay tuned for our next class coming up next. Bye-bye.